Since releasing Q4 earnings, Root stock has pretty much been on a straight line up, tripling in the last 2 weeks. As a Lemonade investor, it can feel a bit like you're missing out watching another insurtech company triple, while Lemonade has much more modest gains. Welcome back everyone, my name is Arias, and in this video I'll be introducing the fundamentals of Root through the lens of a Lemonade investor, while comparing the two companies to determine if I should feel like I'm missing out on something, owning Lemonade instead of Root. Let's jump right into it. Let's start out, as we always do, with what Root does as a company. Root is an insurtech company founded in early 2015, right around the same time Lemonade was founded. They first focused on car insurance, but have since expanded to offer renters insurance as well. They offer homeowners insurance, but through a partner, Homesite Insurance, which is the same partner that Geico and Progressive use to sell their homeowners insurance. One of the more unique aspects of their company is that they use a 2 to 4 week test drive period to better price customers. Customers are evaluated on a variety of different factors, such as how much they use their phone while driving, how sharp and how fast they make turns, and how hard they brake. After this driving period, Root thinks they can better determine the level of risk you pose and price that accordingly, meaning that customers with lower risk compared to others in their traditional insurance cohort should get better prices than are being offered elsewhere, therefore enticing them to sign up with Root. The opposite should be true as well, with Root attempting to exploit a similar flywheel as Lemonade that attracts good customers and drives away bad, solely on the basis of being able to accurately price risk. Root is a mobile-first company and offers quick and easy claims, as well as a sign-up process of less than 60 seconds, because they place much more focus on your driving behavior from your driving test period than other factors like gender, age, or credit score. Root hasn't launched overseas, but is available in some form in 35 states. I broke this map down further into what specific insurances are offered in each state. As you can see, Root doesn't offer any insurance in some of the more northern Midwestern states, as well as in New England. They are headquartered in Ohio and are thus relatively Midwest focused, as you can see with the group of green and blue states. I found this map fairly illustrative of Root's geographical footprint. Let me know if you'd like to see one for Lemonade. Root's time public has been anything but quiet. They went public back in late 2020, just a few months after Lemonade, but raised a massive $724 million. Their valuation at the time was north of $6 billion. In 2021, Carvana, the used car retailer, invested in Root and launched their partnership soon after, making it easier for Carvana customers to purchase Root insurance for their used cars. At the time, Root had already taken a pretty big dip since IPO, allowing Carvana to invest $126 million for 5% of Root. I believe Carvana sold the majority or all of those shares during their financial troubles, but that stake would be worth just $20 million today. In August of 2022, less than 2 years after IPO, they were forced to do an 18-to-1 reverse stock split to artificially elevate their share price. About a year later, in June of 2023, they rejected a buyout at $19 a share, or about $180 million valuation, from Embedded Insurance. This was a massive premium at the time, as shares were trading around $6. The Root team was said to have asked for several stipulations on the deal that Embedded Insurance later agreed to. This drove the share price up in the meantime, but at some point, Root said that they did not have any actionable offers on the table for a buyout, and the deal never went through. That was pretty surprising to hear management not take a deal that was supposedly offering over double what their shares were worth at the time. Now investors are probably quite happy that management didn't accept that offer, with shares trading at double that buyout price. But despite the unbelievable move made in the past 2 weeks, they are still down over 90% from IPO, which has to be weighing on investors and employees alike. Let's get into now what earned a 350% move in the stock in less than 2 weeks, following their Q4 2023 report. They grew new written policies by over 350,000 in the quarter, up nearly 55% year over year. Now that's pretty fast growth, but gross written premium blew that growth rate away, growing 128% in the quarter. According to management, these were both driven by record-breaking direct-to-consumer growth rather than growth via partners. You can see that in the bottom chart here, as embedded offerings, like the one with Carvana, declined significantly year over year as a percentage of new policies written. You can see an additional effect of the growth is a lower percentage of premiums coming from renewals. I would suspect this is being driven by both improvements in pricing, driving bad customers away, and lowering prices on the remainder, and by writing new policies to newly acquired customers. And despite all of this growth, they significantly improved their loss ratio by 11 points, down to just 66%. Their loss ratio is held steady at the current levels for about the whole last year, a huge improvement despite declining renewal percentages. They increased unencumbered cash in the fourth quarter by $5 million, which on its own isn't particularly impressive until you compare to Q4 of 2022, where unencumbered cash decreased by $70 million. They reduced their net loss drastically and even almost turned a profit on an adjusted EBITDA basis. Their operating loss was down to just $12 million during the quarter, and they stated they are focused on getting profitable with just their existing capital. Overall, this was a great quarter. Growth exploding while losses are coming way down. How much more could you really ask for? Well, for the only real knock on this, you have to look back more than a year, and you see their comps weren't exactly top-notch, especially with regard to top line. Looking back, Q4 of 2022 saw a 25% decrease from Q4 of 2021 in terms of gross premiums written, making it an easier base to show growth from. The same holds true when looking back over the annual metrics. The top line has returned to growth, while the bottom line has steadily improved, which is exactly what you want to see as a Root investor at this point, despite the step back in 2022. Now that we have at least a cursory understanding of what Root is and what they do, let's compare that a bit to Lemonade. First, as to how they acquire customers. Both primarily utilize direct-to-customer distribution, enabled by the digital world that we live in. However, while Lemonade basically only uses direct distribution channels, Root takes advantage of partnerships and even some traditional agents to get to customers. As I understand it, the traditional agents are few and far between, but partnerships are sometimes more heavily leaned on. However, that has come down in recent quarters to as low as 4% in Q4. These additional distribution channels have both puts and takes. Lemonade has decided to forgo them in favor of more direct control over their customers' experience and greater long-term value. Root has decided to use them because it can help them reach more customers from different backgrounds and expand faster in certain situations. I would generally lean towards Lemonade's approach for the long-term profitability and control of my business, but I understand that there may be different benefits to Root's approach that are useful. Another massive difference between the two companies is Root does not underwrite their own home insurance. Home insurance, of course, is a huge product, and to choose to partner on a product like that takes away a significant amount of long-term value. Short-term, I'm sure it's allowed Root to avoid losses in that sector, but long-term, it caps their upside in a big way. Both companies use quota share reinsurance. However, Root uses significantly less than Lemonade does, at around 18% quota share rate, whereas Lemonade is somewhere north of 60% from my recollection. This means Root is taking on significantly more risk than Lemonade, as they are responsible for significantly more losses if something catastrophic were to happen. This also does give them more upside in the short term, as they are paying less for reinsurance. Another effect this will have is Lemonade will need to have less restricted cash on the balance sheet, as the amount of reinsurance affects the amount of cash needed to be retained, with more reinsurance needing less retained cash. Reinsurance rates will ebb and flow, and assuming nothing terrible happens, will all get to the same place over the long term, and thus I see this as a non-factor. Moving on to efficiency, Root appears to be much further down the road, as if you look at the IFP to headcount ratio, Root writes significantly more premiums per employee than Lemonade does. There could be a few reasons for this, most of which have to do with the companies themselves. Root has been under huge financial strain over the past years, so much so that they've had a round of layoffs, while Lemonade has not been forced to do that so far. Lemonade has said that they are letting people leave as they will from time to time and not replacing them, and using that as a way to reduce headcount, but not firing people outright. I would expect Lemonade to catch up to some degree as that process takes place, but we'll have to track that as it plays out going forward. Another contributor to this is Lemonade builds more of the processes and products in-house than Root seems to, like homeowners insurance, meaning Lemonade will require more engineering headcount, making their business appear less efficient in these early states of growth. Another example of this appeared in a press release back in 2021 where Root said they are partnering with SafeKeep, a company that uses AI to help with the claims process. This is the sort of thing that Lemonade would likely have built in-house, requiring more engineers and making their business look less efficient. However, this should go away over the long term as Lemonade grows and doesn't need to scale headcount like a traditional insurer would. Another key difference is the background of the founders. Alex Tim is the CEO of Root and founded the company back in 2015. He has an extensive background in the insurance industry and thus a very different background from Lemonade's founders, who were more serial entrepreneurs. This isn't necessarily one being better than the other, but it's just interesting to see how different backgrounds may have manifested themselves differently in choices for their respective businesses. Moving on to comparing their financials. Root has better financials in many ways. They have more IFP and are growing faster. They have lower expenses, and as a result, in 2023, they have lower net loss as well. However, the script flips when it comes to overall financial position, with Lemonade having more cash and no debt, while Root has almost $300 million in debt and warrants, all at a very high interest rate, I might add. The lower cash loads and lower reinsurance rate on top of more IFP leads to Root having significantly less unrestricted cash than Lemonade at this time. This adds some risk to Root that despite their solid operating performance recently, they are still on shaky ground when it comes to their underlying cash balance. And that's reflected in their valuation of less than 2/3 of IFP, while Lemonade trades at significantly higher than a 1-to-1 ratio. This is a lot of what investors have to balance. Root has performed better of late, but has a more precarious position, and if things sour, there's a much longer way to fall. On the other hand, if they've really figured it out, there should be much more room to run based on their current valuation. Lemonade may have a bit stronger of a base, and for the time being, still have enormous upside because of the market they're going after, leaving hard decisions for investors. Finally, for my conclusions, Root is an insurtech company that uses AI to better price customers. Similar to Lemonade, they're not burdened by traditional distribution channels, legacy systems, or bad customers, leaving them with a ton of room to expand. While I do see some merit to additional distribution channels that Root uses, overall, I prefer my company to have full control over their stack and long-term value of their customers. However, Root has seemed to figure out the pricing of car insurance, while Lemonade is still struggling a bit to get into that massive market, which is a knock on them for the time being. Overall, though, I like Lemonade's bundling strategy along with their better financial position and long-term view on their products. Thus, I will not be picking up any shares of Root at this time, even though I fully admit that their shares potentially have a lot more room to run, even in the short term. I won't be picking up any Lemonade either in the foreseeable future, but if an opportunity presents itself, I will be ready to take advantage. Thanks for watching and have a great rest of your day.